You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, Jim, good to be with you. Here we are. It's Friday, and we're looking over our shoulder backwards at the market and also trying to look over the other shoulder forward into what's really going to be happening next week.
The Asian market's super red hot right now.
Oh, yeah, they're getting a rush of speculation that hasn't been seen since 2007. Of course, this is on top of our measurements on the U.S. Stock market, which has been, like on the S&P and things like that, have been generating momentum and sentiment figures that you only see at cyclical peaks. So, and then now you've got a rush of straight-up stuff in Japan, in China, where for the last few weeks, the report we have is they've been signing up new accounts at the rate of 1.5 million per week. And I don't know how many weeks it's gone on, but 2 anyways. And of course, what this means is you need a whole lot of new brokers to look after that. And then they're also doing a whole lot of new issues of junior stocks, which is everything's flying to the moon. And I remember personally being in a new issue market in 1968 that was absolutely fabulous. New small stocks were coming out and doubling and tripling. It was wonderful. And there were many new clients being signed up, and there were new brokers, and then they eventually did it to themselves, and then everything went into the tank. So let's just look at this in a experience perspective. Is that on our measures on the U.S., there was the slide in the S&P into October, which is often a seasonal low, and also at that time our technical piece gave what we call a springboard buy, and that model only works in an up market. So it gave a springboard buy in a rising market, and we noted the October tendency to be low and the May tendency to be high. And then the continuing crash in crude oil down into January was a depressant for a while for most stocks. And then we've been kind of looking out of for here a rotation into some of the beat-up commodities. Sort of with some amusement yesterday wrote that where last year at December we were looking for the rotation into beat-up commodities, and we put the term rotation in quotation marks and used capital R because we were quite positive about the trade. This time we've used a small r because we could get into May. Some of the commodities are recovering. You had that horrible crash end in January, which was that thing, if you count on previous hard bear markets for crude oil, they could go for 6 to 7 months, and January was the 7th month. So then we thought that crude oil would trade for a number of months in setting a bottom, but what we think is this could make it maybe into May. This is positive commodities, even if it's slightly positive, would be positive for the stock market. And we have also this, with the crash in crude oil, you had a lot of pressure on junk bonds because I think, about 18% of new issues of junk were for energy-related companies. So then we've had relief in the junk market. Actually, that on J&K, that was down and registered a downside capitulation in January as well. So these things have turned positive, and we think they can kind of continue positive into May. Now, to get back to intense speculation in China, the one index that's covering some of this is the FXI, which is a sort of a Chinese stock index, trades in Hong Kong, and as I said, it's been going straight up. And then, as I said, also the phenomenon of opening up millions of new accounts. And so we look back into some of the quotes we got from 2007, and you've got, they were doing the same thing. There was one about a guy in November 2007 in China wanted to put in a trade, but he couldn't get to the computer because there was a lineup of people entering their trades, and he sort of got frustrated. And but they were also adding millions of new accounts then. So the importance of the one in November was, of course, that was just after the stock market high in the S&P in October. So here we are. We got extremely speculative readings for the senior indexes in New York. Within this, we had the hot tech group, the biotechs. IBB is the symbol, and a couple of weeks ago it was going straight up, and that gave a very serious upside exhaustion readings. It was on the daily, the weekly, and the monthly, and that was pretty rare. So we kind of like to watch a group like that when it gets so excited, because it sort of it has been the best big section on the big board, and it blew out. So we also noticed that the transports have been weak on the old Dow theory. So technically, there's a Dow theory sell signal on the overall New York market. Also within this, the action you had when it made new highs a number of weeks ago and then backed off, it looks like what would call a false breakout. So we're watching that. And I don't want to sound like we got a foot on each camp, but we're looking at Dow theory and breakout, which shows the market is precarious. We're also looking at seasonal, which can be generally benign for a number of weeks yet, and we see incredible speculation in China and Hong Kong. So, and that they also, you can see in the markets often very silly events blew up in April or May. So this is on season. So we're going to keep a foot in each camp, monitoring the senior indexes in New York, and we'll also watch, not trade, the hot action in Asia, and somewhere in the next 6 weeks, I guess this could reach a crescendo. And also, whatever firming of commodity prices would probably reach the best for the year. So then one other item on the fixed income side is that we've been watching the yield curve. That's the difference between long-dated Treasury and short-dated Treasuries. And in a boom, whatever kind of boom you've got, this has been the U.S. economy strength has been moderate, but so the curve has been what we call flattening. But if this was a stronger boom like 2007 or 2000, it would actually inverted with short rates higher than long rates. But at the best, we got here this flattening curve. Now, we watch this because often the expansion, the boom, whatever you want to call it, can run for 12 to 16 months against the flattening yield curve. So March was month 15 on the count, and as we look at it here into April, that action which was trending up is kind of stalling out, begin to roll over. So that for the last 15 months has been a positive for the stock market, whereas when you had credit spreads widening, which is the difference between high-grade and low-grade bonds, they started to widen last June and really widened with the crude crash. Now, they can be benign in here. So perhaps after the mid-year, on the credit market side, you could have the spread widening resume, which would be a negative for the stock market, and you could have a more pronounced move toward this change in the credit in the curve to steepening. And some people like steepening, but when you're in a full bubble environment, the turn to steepening is a warning item. And then that brings us to our friends over in the precious metals department, and we have been more or less out of the game since the last sell signal, which was in May a year ago. And you had, remember we talked about a rotation with a capital R. We had a very good rally in gold, silver and gold, and it was so strong in silver that the RSI on the silver-gold ratio got up to, I think it was 82. Anyways, it was high and in dangerous territory, and we advised that it was dangerous and it was time to take money off the table. And then going back now to early November, where we put out a piece, caveat venditor, which was let the seller beware, that we were beginning to look for a long bottom in the precious metal sector. Shorts could cover, and you could begin to accumulate some gold stocks on weakness. That's still our view, but we're still not fully invested. And I can't see anything to get excited about, and other than maybe some positive action into mid-year. But after mid-year, I think the real price of gold can start another move up, which would be positive for the sector. But after mid-year, if there's problems in the credit market and problems in the big stock market, it may not be too friendly for gold stocks. So we'll stay tentative, somewhat invested, but not fully invested.
We'll have more with Bob Hoye right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Bob Hoye. Bob, we looked at the Asian markets to start off the show. Is part of the high numbers we're seeing the distortion caused by the rising U.S. dollar?
Well, yes. That started in the summer when the U.S. dollar started heading up. We were prepared for a strong move in the U.S. dollar, so that when it became overbought in the summer, sort of average overbought, we noted that it was overbought, but we noted that the U.S. dollar could go to a serious, super overbought. That was the term we used. Of course, that really tied to the crash in crude oil, so that then in January, when crude oil got super oversold, the U.S. dollar got super overbought, and we've been looking for a correction phase in there. The dollar index DX can trade sideways in here, but one of the things that, surprised was that with the collapsing euro, there was a lot of big serious money came over to be in the U.S. dollar, and it's just not making any sense just to go long the dollar or long treasury bills. So they were buying the most liquid stocks, the big stocks in the S&P. So you had that hot action, the currency play of buying. So this then, if there is a liquidity problem in Europe after mid-year, that would be some of that hot money would go back home, so there would be pressures on the big market. But we're also getting pretty good retail participation coming back into the U.S. market because the small caps, the Russell, have been acting very well. Nothing greatly speculative yet, but we should always watch a junior market like China and Hong Kong now for their technical excesses, speculative excesses, because that is it's sort of the pulse of speculation, and if it burns out one place, it sort of burns out elsewhere. So it's very important to watch what's going on in China right now, and also to watch what's going on with the Russell small caps, because people are coming back into the market.
Bob, thanks a lot for chatting with us.
Always good to be with you on the Fridays.
My guest has been Bob Hoye, market historian and chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our popular YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.